All right, welcome again to Student Loans Update number 7. This is obviously the 7th webinar in our Student Loans Update webinar series, which is also part of the Get Savvy, Grow Your Green Stuff webinar series that we do annually. My name is Andrea Pellegrini, and I run the Student Money Management Center for the entire University of Illinois system. So that's Urbana, Chicago, and Springfield. And I'm joined today by my colleague, Nikki. Nikki, do you want to introduce yourself?
Sure. My name is Nikki Jankola Shanks. I am the policy director for the Division of Banking within IDFPR, which stands for the Illinois Department of Financial and Professional Regulation.
Thank you, Nikki. So we're gonna launch a very short little poll that helps us kind of get an idea of who is here with us today. And they move the polls on me, so hopefully this works. There we go. I just launched it. You can just let us know your age range, whether you're a student, full-time employee, whatever your student or employment status is, as well as some other demographic information. That helps us cater the information to our audience, but it also helps some of our colleagues in University of Illinois Extension that partner with us on the Get Savvy series to maintain funding for partnering with us and providing this type of content. So we really appreciate that. All right, everyone, almost everyone has participated. Thank you. So it looks like we have a pretty big age range. Anyone from, we have 25 to 74 represented here. So really appreciate you all joining us, regardless of what your role is in the student loan repayment process. We have some students as well as mostly full-time employees and good gender distribution. Thank you so much. I'm going to stop sharing. If you still see the results, you can just exit out of that window in order to see the slides that we're going to be discussing today. So we are going to be focusing today's discussion on qualifications for public service loan forgiveness. We're going to talk about what repayment plans qualify for public service loan forgiveness. And we're also going to talk about some of the things to consider if you're earlier in your career and looking at public service loan forgiveness as an option for managing your federal student loans. We also want to remind you that any information that we discuss today about federal student loans is rapidly changing. So what we are able to discuss today is current as of January 19th, 2024, and we're at noon Central Standard Time. So we can share a lot of general information, but we can't really provide financial advice on specific situations, but we can refer you or provide some clarifying information if you're confused about how to ask for help when it comes to talking to your servicers about that. All right, I'm going to hand it over to Nikki to talk about some of the requirements of public service loan forgiveness.
Thanks, Andrea. So to get us started, just to give you guys a little bit of background on the program was first created in 2007, and the whole point of the PSLF program is to encourage people to enter into the public service sector. Maybe not forever, but at least for a set given of time to encourage that public service. There were certain criteria that needed to be met that was laid out when the bill was signed into law, and which we're going to talk about those more in depth. The first set of borrowers that began to have their loans discharged or the rest of their loans forgiven, the first batch became eligible in October of 2017. So this again, we're giving you this background because sometimes as we talk about this program, what I have learned through teaching about public service loan forgiveness is that people get really confused over the qualifications and if they're a public servant or not, or why doesn't this loan apply for a term as opposed to this loan or whatever it might be. So to have this background that the whole purpose of this was to encourage people to give part of their careers to public service helps to kind of frame some of these other jobs and things like that as we talk through the specifics. So public service loan forgiveness, three main parts that bare bones that you need to do. You need to make 120 payments in qualifying repayment plans. We're going to go through what qualifying repayment plans means in depth. 120 payments, it is one payment per month. So 120 payments is 10 years. So again, going back to the purpose of this law, the purpose was to encourage people to work in some sort of public service job. Okay. So 120 payments, 10 years, working in public service. And then it's what it does at the end of those 10 years is it forgives the remaining balance. So this is not a program that's going to, if you have $50,000 in loans, they're going to forgive all $50,000, right? It's a program that you need to make payments for 10 years while you're working in public service, and then what's left over is then forgiven. Okay, so now we're going to talk a little bit more specifics. First, the 120 qualifying payments, again, 10 years of service. It does not need to be consecutive. So what does that mean? That means, let's say in my career path, I started as a teacher, right? And I taught for 2 years. Then I decided to go work for a textbook publishing company that's no longer public service. So I worked there for 5 years. And then I was like, you know what? I miss teaching. I'm going to go back to public service. I'm going to go back to the classroom. Once I entered teaching again in a public school, then those payments would count. But those first 2 years still counts towards my 120. So you don't have to work 10 years all at once. Your payments cannot be late. If they are late, they are not counted towards your forgiveness. If you're a day late, there is no guarantee that your servicer is going to count that month's payment towards that 120. Also, your payment needs to be in full each month. Now, there have been some changes recently with PSLF where let's say you get paid twice a month and you wanted a little bit taken out of your paycheck each month to reach each paycheck to reach that full payment, that's fine. But the bottom line is at the end of the month, by your due date, everything needs to be paid. That payment needs to be made in full. So direct loans, there are lots of different nowadays. Like if you're a more recent borrower, you likely already are on a direct loan because that is the main type of loan now. However, there are loans such as FEL loans, Perkins loans that are a little bit older that they no longer issue. You can still be eligible if you have those loans, but you first have to do a consolidation into a direct loan. You need to be in a qualifying repayment plan. Again, we're going to go through these repayment plans, but basically you need to be on an income-driven repayment plan. You can be in a standard plan, and like I said, we'll talk a little bit more about this, but the standard plan is 10 years of payments. So, and then it's not anything special. It's going to pay off your loan in 10 years. So then you don't really need the public service loan forgiveness program. So yes, technically you could do both, but to get the most out of the program, you need to be income driven repayment plan is the way to go there. Then working for a qualifying employer. So this is any type of public service. Okay. So a 501c3, those are nonprofits, right? So if you work for a nonprofit, no matter how big or small, it would count. Any type of government service. I mentioned teaching. Teachers do count as government public servants. So they would be included. Firemen, policemen, any sort of government job, working at the DMV, whatever it might be, counts towards um, public service. And then there are some specific industries that that may also, like a not-for-profit that is established within a different industry, that the industry itself may not be not-for-profit, but they may have an arm that is doing non-for-profit work. This means that, like, the tricky thing about qualifying employer to keep in mind is if you are a contractor, you need to make sure that you are being paid by the entity, you need to make sure you're being paid by the public service organization. So, for example, a lot of people, paramedics and ambulance drivers, run into this issue where a lot of times they're a paramedic, but then they're contracted out through a private company, and they're actually being paid by a private company, even though they're doing public work for, their local fire department. You need to make sure that you are being paid by the public service entity. And then all of those together will means the remaining balance of your loan is forgiven after 120 payments. It's also important to note that the forgiven amount is not taxable by the federal government. IRS will not have you pay taxes on that, but it could be taxable in some states. In Illinois, it is currently not taxable. So, but if you are logging in from a different state, you would need to look at your own individual state laws for that. All right, so there have been a lot of recent changes to PSLF. It's been in the news a lot as well. So I'm going to briefly go over some of these. So the first is the temporary expanded public service loan forgiveness waiver. This was actually passed in 2018, and it has limited funds. Like, once the funds that was allocated to this program is out, it's out. But basically what it means is that if you were in the wrong payment plan, it allows you to still be a part of PSLF and allow those payments on the wrong plan to count. The nice thing about this is that the PSLF help tool, which is on the student aid website, which we'll talk a lot about. If you go through the steps, they're going to tell, like, the help tool will tell you if you apply for this, if you can be a part of this program. It's not a separate application. It's not anything addition that you have to do. The limited PSLF waiver, this was what was really in the news a lot. It allowed loans that didn't qualify before to start qualifying for PSLF. However, this program ended at October 31st of 2022. So that part is no longer an option. There were a lot of people, though, who entered the PSLF program through this limited time waiver. And if you are somebody, if you are on this call and you have that, you did apply during that time and have questions, I'm happy to try to answer them at the end. Then this last piece is called the income driven repayment, IDR, payment count adjustment. This is being done on a rolling basis. Okay. It's expected to continue all the way through summer of this year. This is taking the Department of Ed is automatically looking at individual borrowers' payment history and adjusting it to with the hopes that it increases your count. So what I mean by this is some people who are on an income driven repayment plan, um, maybe they had their payment may have been off by 2 days and then it didn't count, or maybe they thought they paid it in full, but really their uh, payment had gone up by $5 and they had missed that and then it missed a payment, etc. The Department of Ed is basically going through all of the borrowers who are in income driven repayment plans and looking at them individually and making adjustments and allowing some of those past quote unquote mistakes to count towards your income driven forgiveness or cancellation. Again, the nice thing about this is there's nothing that borrowers have to do. You just have to be in an income driven repayment plan, and the Department of Ed will do this automatically. As I said, it's a rolling basis. So what they did was they started this this summer, and in priority order, they kind of did people who were close to forgiveness first, so that way they would hopefully get discharged faster, and they're doing them in certain batches. We have had reports of people, this IDR adjustment helping a lot of people. I personally have a friend who thought she had 18 payments left to make on her plan, and she now has two. So they are going through. It just may, if you're thinking I'm on an IDR plan, nothing's happened to mine, it could just be that you're not in that bucket yet. All right, I'm going to pass this over to Andrea to talk about if PSLF is an option for you.
All right. Thank you so much, Nikki. So, since I usually work with people getting ready to graduate or new graduates, a lot of the time, people early in their career are trying to figure out if public service loan forgiveness is even a viable option for them to consider for managing their federal student loans. So, I've kind of framed it in this decision tree, but first you need to identify if you have federal direct loans. If you have FEL loans or Perkins loans, you might have to consolidate. And consolidating early will give you more options for repayment and handling your loans. You also want to look at if you are employed by a qualifying public service organization or you intend to be, if you're not quite there yet. And if you are, then it might be a good option for you. If you are only wanting to do that for a couple of years and then transfer into something else that might be more lucrative or give you, like maybe you want to work abroad instead, then it might not be a good option if you're not going to work a whole 10 years in public service. You also want to consider if you're going to be on a qualifying repayment plan, typically an income-driven repayment plan. You can, like Nikki said earlier, be on the standard plan, and those payments will still count. But let's say you're trying to figure things out your first year into repayment, and so you stay on the standard plan, and then you decide after getting a little bit of experience that you do definitely want to stay in public service, or you want to transition to public service, then making sure that you're getting into that income-driven repayment plan as soon as you've figured that out will be helpful for you to make the most of the forgiveness at the end of the 120 payments. We also want you to think about there might be other options that you can consider. If no is your answer to all of these questions, you might have to look at other research, like how you consolidate your FFEL loans. They're also called uh, federal family education loans, if you've only heard of them that way, into a direct consolidation loan. So those are some things to consider if you're early in your career and you're looking at whether or not public service loan forgiveness will work for you. The other factor that I didn't put on this slide that will be valuable to think about is if you are going to go into public service, but you have a low amount of debt and you have high income, then an income-driven plan may not give you any benefit. So, for example, both my husband and I work in public service. I paid my loans off several years ago, but he is getting ready to start, or has just recently started a repayment of his loans. And we looked at what the public service loan forgiveness options would be for him if we were to take advantage of that. And our combined income, since we file our taxes together, is so high that we would pay off our his loans within 3 years if we used the save plan. So that would not qualify for public service loan forgiveness. And so that's a more nuanced thing to consider if you're looking at public service loan forgiveness. So one of the things that we talked about a lot earlier was qualifying repayment plans. So we're going to elaborate on that now. So the first we got to define the eligible loans. It's only direct. So that means direct parent plus loans. That means direct grad plus loans. That means direct consolidation loans. It also means direct unsubsidized loans and subsidized loans for undergraduates. You can consolidate both Perkins and Family Federal Education loans into a direct consolidation loan. But in order to pull in Perkins, you need to do some extra work. And Perkins has its own forgiveness benefits. So you want to evaluate that before you decide to consolidate your loans. The loans that are not eligible for public service loan forgiveness on their own are Perkins, the Family Federal Education Loan Program, and institutional or campus-based loans. Those are loans provided by your school. So there are technically 5 qualifying repayment plans, but in order to make the most of your qualifying payments, you want to make sure you're using an income-driven repayment plan. Like I said earlier, standard repayment does count, but if you stay in that the entire 10 years of your service, you've already paid off your loan, there is no loan forgiveness. So the income-driven repayment plans that you want to look at is SAVE. This was formerly the Repay program, or Repay repayment plan. PAYE, P-A-Y-E, income-based repayment, or income contingent repayment. So those are the 4 income-driven repayment plans that you would want to pay attention to right now if this is something that you want to pursue. As far as the qualifying payments, Nikki already went over this a lot, but just to remind you, that it needs to be 120 monthly payments. It must be made after October 1st, 2007. So you might have been in and out of school for a long time. You might have had different things in your career happen, but any payments made before 2007 wouldn't count. It also needs to be, like Nikki said, for the full amount as shown on bill. It can be, you can make 2 payments in order to get to that full amount as shown on your bill or your dashboard, but it needs to be paid in full no later than 15 days after the due date. So the servicers are required to give you a little bit of a leeway when it comes to after the due date. And because we are currently in the on-ramp to repayment, there could be a longer leeway for that, but you still want to try to make those payments on time. any payments that you make while you're in school in deferment during the grace period, that 6 month period after graduation or after leaving school, or in deferment, forbearance, or default, do not qualify. So earlier when Nikki was talking about the fact that those 120 monthly payments don't need to be consecutive, it also means not just career changes. It also means like maybe you were in deferment because you went back to school, or you had an emergency that reduced your income, and so they put you in administrative forbearance. We just went through about 3 years of administrative forbearance, where all those are an exception. All those months that we were in the payment pause were an exception to this rule. And so those will qualify, but most of the time, those payments do not qualify. So, like I just said, any months that occurred during that COVID-19 suspension do count as qualified payments towards public service loan forgiveness, even if you didn't actually make a payment. So that's kind of the nuanced aspect of public service loan forgiveness qualifications regarding payments now that we're in this post-COVID era. And I can hand it back over to Nikki to talk about what typically doesn't count for public service loan forgiveness.
Thanks, Andrea. So there are things that, and we've mentioned some of these already, but this is what does not count. Partial or late payments do not count. Time spent in deferment or forbearance, but as Andrea said, that does not include the pandemic COVID-19 forbearance. That is a very unique situation that we hope to never have to go through again. But so any other time spent in deferment or forbearance. Any payments, if your loan is in default and you make payments on a defaulted loan, those payments will not count towards forgiveness. There are ways to get out of default. The Biden administration has launched some new programs called Fresh Start. So if that is something that may apply to you, I would suggest going on studentaid.gov and looking for the Fresh Start program, and what your options are there. So then typically payments that were made on a repayment plan that does not qualify for PSLF, such as example, the graduated extended repayment plan, that typically does not count towards your 120. Now, again, with this IDR adjustment stuff, maybe it will count, but in general, it does not, and it will not count going forward for sure. And then any payments on any loan that was distributed to the borrowers before October 1st, 2007. And that's just because this law was not in effect then. The law didn't exist. So if your loan is from before 2007, and you were paying on it, those payments will not count. All right, so this payment count adjustments, I've already talked a little bit about this. It is, I'm just gonna be honest that it's confusing. But the important thing to remember here is that these count adjustments are automatic, and that the Department of Education is reviewing that, and anything that qualifies will be adjusted automatically. Borrowers don't have to apply for a special program in order for this to be taken advantage of. So this is, you basically just need to be in an income-driven repayment plan. Even if you were in an income-driven repayment plan and then you switch to a different plan, they're still looking at the time that you were in an income-driven repayment plan. So again, that's something you may want to look into if you're not on an income-driven repayment plan. Regardless if you pursue the PSLF aspect or not, you may want to look into that. So as they go through and they make these account adjustments, and hopefully, as the example that I gave, my friend who went from 18 payments down to 2, some went to complete forgiveness, that, and then their loans were discharged. To date, over 3.6 million direct loan borrowers will receive at least 3 years of credit towards loan forgiveness through these account adjustments. And again, these adjustments are going to continue throughout all the way through this summer. So, if you have any more specific questions, you could visit the website but just know that, like I said, as I mentioned before, they are on a rolling basis. All right, so taxes and loan forgiveness. You may have heard that when your loans are canceled or forgiven, that you have to pay taxes on that. So I'm going to talk about what's different between the answer is yes and no. So the first is that any balances that are forgiven through the Public Service Loan Forgiveness Program is not taxable. You will not get a tax bill on that from the federal IRS. Okay. How, as I mentioned, some states may require taxes to be paid on the forgiven amount. Illinois does not. That much I can tell you. Other states, you're going to have to do a little bit digging. Now, typically, so that's forgiveness, right? You went through this program and it was forgiveness. Then balances that are forgiven through the income driven repayment cancellation. So let's say you just are on an income driven repayment plan, you paid the amount of years that your particular plan says, you're not doing the public service route, but just the IDR route. That cancellation typically will be taxed. However, the American Rescue Plan Act included in it that that all balances that are forgiven through IDR cancellation through 2025 are exempted from federal taxes. After 2025, if your loan is canceled after that, then you may be subject to federal taxes. We just don't know yet because they could decide to extend this for a few more years, whatever it might be. But for right now, through 2025, IDR cancellation, no federal taxes, and balances that are forgiven through the Public Service Loan Forgiveness Program you're never taxed by the federal government for that. All right, so consolidation, sorry, if you have a FFEL loan or Perkins loans, you can consolidate those into a direct consolidation loan. That would then make your loan eligible for public service loan forgiveness. But the important thing to remember here is that when you consolidate and it becomes a direct consolidation loan, your payment counts start over because it is a new loan. It's like because you've never paid on this direct consolidation loan. So if you do have these other types of loans and you're thinking about public service loan forgiveness, you really need to think through what you've already put in, how much you have left. So for example, okay, let's say you have the FFEL loans and you're on an income driven repayment plan, and I've been paying on my FFEL loan for 15 years. So that means I have 5 years left. Let's say my loan term 20 years. If I consolidated my FFEL loan into a direct loan, now my payment count, instead of having 15 years in, starts at 0. And then I'd have to pay another 10 years to have my loan forgiven, as opposed to maybe just making my payments for 5 more years. So that's something that that individuals have to weigh. You have to look at your unique circumstances, um, to to see if that type of consolidation would actually benefit you. Um, that is something too that you could call your servicer about, but you just may want to think through, look at, my suggestion is always to log in, look at your types of loans, look at your loan balance, how much you have left to pay, etc.
All right. So we're just going to wrap some of these things up. And there were a couple questions that I think we should answer live that we got in the chat. So just as a reminder, public service loan forgiveness is only available to direct loan borrowers and has several requirements, which we went over. The payment count adjustments towards loan forgiveness or cancellation are being done automatically. So there's nothing you have to do through summer 2024. It might take longer, but as of now, they're publishing through summer 2024. And then you might want to consider direct loan consolidation if you have other types of federal loans that could be eligible for public service loan forgiveness. And I believe Kobena just put in the chat that you can use the Public Service Loan Forgiveness Help Tool or PSLF Help Tool to confirm your eligibility for PSLF and to fill out and submit your form, including recertification for employment and other things that you might have to do annually. So just keep those things in mind. Again, this is a partnership with University of Illinois System and IDFPR, and we are going to answer some questions now. So 2 questions we got in the chat or in our Q&A session are very valuable. So our first question is, would being a substitute teacher qualify for public service loan forgiveness, or since it was less than 20 hours per week, would it not qualify? So Nikki, do you want to answer this or do you want me to answer this?
Yeah, I could jump in and answer. We should have, this is a great question because it does need to be a full-time job. So it's whatever that particular institution um, considers full-time. So for example, for me, working for the state, our full-time is 37 and a half hours per week. A different, nonprofit job, maybe 40 hours a week, but you need to be labeled a full-time employee.
Thank you. I agree. It's the same as far as 37 and a half being full-time at U of I, which is a 501c3 and does count. And it's also a state institution, so it does count from a government perspective towards a qualified employee. And then the other question is, since we have to qualify employment for public service loan forgiveness, is there a way to automatically do that every year or so? So it's not automatic. You kind of have to you have to initiate the process yourself. Nikki, do you have the process memorized? Because I do not.
Yes. So it's really annoying. There's no other way to do it. You will not get reminders to do it, but we highly recommend that you certify your employment every year, because at the same time that you certify your employment every year, you will also get an updated payment count towards your public service loan forgiveness. So, in order to certify your employment each year, you need to go through the help tool, the PSLF help tool. You fill out the public service loan forgiveness form that is on there that asks you to what job you're in, etc. Even if nothing changes year to year, we recommend you fill that out, because your servicer then has record that you are still in that program. It is much harder to do this. Let's say you're like, okay, I'll get to it, and then you change jobs, but you change jobs within public service. You have to have all of your years certified, which basically just means now you go on the help tool, you fill it out. The system will automatically now send an email to who you send it. So, for example, my boss is the director of banking. If I need to certify my employment, I fill it out. And then at the end, it's like, who can we mail this form to verify that you were employed? So I would send it to my HR department. They would do it. It's not paper. It doesn't have to be paper anymore. They will email them. Um, but it gets really confusing. We've seen more issues on my side, which we regulate the loan servicers for Illinois. We get lots of complaints from borrowers who are PSLF borrowers who forgot to certify employment, or they saved till 10 years, their 10th year, they think that they're in forgiveness, but now they have to go back 10 years. If you've had different jobs, it can be really hard to find people to sign off. Um, maybe HR change the way they do things, whatever it might be. It's a lot easier to keep track of it year by year by year than trying to do it all at once, because we've seen a lot of problems that way. So, what we always tell people to do is literally pick a day, whichever day. Like, let's say today you're like, I'm going to do that, my PSLF application. Then put a reminder in your calendar, however you do that, on your phone, on your email, for January 19th for the next 10 years. And every January 19th, then you would just fill out the form and resubmit it. It makes the forgiveness part at the end a lot easier.
I agree with Nikki. Even prior to the pandemic, when they started making a lot of changes, that's typically what we would say is you need to certify your employment every year. For smaller nonprofits, especially that may not exist for a whole 10 years, you might change employers, like Nikki said. Trying to find someone to validate your employment could be very challenging. Luckily, as if you're a U of I employee, in the PSLF help tool, there's actually a section for University of Illinois, and so they already have that verified, and so they can email it or mail it to the correct HR department to verify employment here. So that makes it a little bit easier than 5 or 6 years ago, where you had to physically print it off and then go find an HR rep to sign it and then mail it back to the Department of Education. All right, so we have some more questions. What if I work for public service for almost 10 years, but I never made any payments? Since I enrolled in school since 2019, would I qualify for a public service loan forgiveness?
So it,
Go ahead,
sorry,
Nikki.
Andrew.
Go ahead,
I was going
Nikki.
to say, so if I'm understanding, and please feel free to type if I'm not, if you work for almost 10 years, but you didn't go to school until 2019, then it has to be from when you started school and took out your loan.
Well, you would have to be not in deferment, and you'd have to still make
Yeah.
120 qualifying payments. So yeah, you still there's those three main components: 120 qualifying payments, 10 years of public service, in and then the remaining balance is forgiven after you've made payments. If you don't make any payments, you wouldn't qualify. All right, so
So,
go ahead.
yeah.
Go ahead.
Yeah, no, I just wanted to say that if I'm understanding it correctly, I understood it that your first loans were in 2019. So that would mean you'd have to enroll and work till 2029 if you
As
did from 2019 to 2029.
and you would need to not be in deferment during that time. So
Right.
typically if you're in school, you're in deferment. You can get a waiver out of deferment, but you could only make payments on loans made prior to your enrollment into courses. So like if you had loans in 2006, or not 2000, let's say 2014, you could make payments on those and it would count. but not any new loans made in 2019. It's very complicated. Hopefully that
Great. Can my
provides. Go ahead.
No, I was going to read the next question, but Daniela, if you still have questions, please feel free to type for us so we can
Yeah.
see them. Um, and can my 120 payments and my 10 years happen at different times but still qualify? For example, I put in my 10 years before first my 120 payments, but I continue to make payments at a non-qualifying job. I'm finished now first. I put my time before. So if you put in your 10 years before you finished your 120 payments, hmm, I,
Yeah, I'm not sure on that one. I don't think we've run
yeah,
across that case. Yeah.
yeah, because I'm not sure if you put in your 10 years before your 120 payments, like it depends. Were your loans taken out that whole time, or did you get like, if you had your loans the entire 10 years, that I'm not sure why you wouldn't have been making those 120 payments. So it sounds like, because if you were in, right, I'm just not sure I'm understanding, because if you're in public service, let's say day one, right? I have 10 years, I had my loan, I was paying on this loan for 10 years as I work.
So
I'm not sure
Nikki,
why you wouldn't be at 120
so
payments.
Nikki, a scenario where this would happen is someone is in public service. Maybe they already are a teacher, but they didn't have any loans. But then they go back to school and get a master's degree, and then they take out loans, but they've already been a teacher for 10 years. Um, would they get would they get forgiveness if they continue to make 120 payments, but maybe they worked part-time or they worked for a non-qualifying employer because they already did their 10 years of public service? I don't think we've run into that question, so it would be a question for a servicer or
Yeah, but my gut is no. And I'll tell you why. The issue becomes, the whole point is 10 years of service, while and they used to want you to still be in your public service job when you asked for forgiveness. So if you're no longer in it, that's going to complicate it more. Um, but this is a question that I would definitely call the servicer on, or call FSA. I will also put my email in and we could talk more specifics, just because I would need more info, and I'm happy to dig into it more. I just like a broader question. It just depends. Like we need to talk a little bit more specifics.
all right. Hopefully we get some a case out of that we can explain because you're probably not the first person to have that question. All right. So, if there are any other questions, feel free to use the Q&A feature or put them in the chat. Again, we're recording this, so we will make the recording available once it's been captioned. It'll probably be next week or the following week, depending on how things roll out. It's early in the semester, so everyone that works for the university knows how that goes sometimes. But hopefully we can get it out to you soon. We also have all of the previously recorded webinars captioned and on our YouTube channel. It's also on the Student Money Management Center website, and it is in the page for registration And we've also been including those links when we send out the follow-up emails and your login email. So you might have already gotten a list of the previously recorded webinars, and they're labeled with the topic that we focused on for that particular webinar. So hopefully that will help you out. Again, if you do have any questions, you can email Nikki or studentmoney@uillinois.edu. So that's the email that sent you the login instructions today. But hopefully you learned a little bit today. Hopefully it's giving you some more information about how to manage your loans if you want to pursue public service loan forgiveness. And we'll stick around for a couple minutes, but feel free to log off and have a wonderful and hopefully staying warm afternoon. It is quite cold outside.